When the options are issued, A, you don't know whether they'll be exercised, right? There's a chance that they will never be exercised. There are lots of companies out there which issued options 2 years ago, 3 years ago, where those options will probably never be exercised. So there's a probability of exercise and non-exercise. The second factor is you don't know what price they will be exercised at, right? They'll be exercised, if they're exercised, they could be exercised 50, 60. The actual stock price might be very different numbers. That used to trouble people. How do we bring in the probability of exercise and how much gets paid when you get exercise, when you actually have the exercise? So let's take a very simple example. Let's take it through the different ways of dealing with equity options. I'm going to take the most common way of dealing with equity options and kind of move up from there. So let's start with the example. You value a company. The company is $100 million in free cash flows, growing 3% a year in perpetuity with a cost of capital of 8%. So you could do this in your head, right? 100 million free cash flow. Forget about the growth. That's going to be the cash flow. Let's say that's a cash flow next year. 100 million is the cash flow next year divided by cost of capital minus growth rate gives me a value for the firm of $2 billion. It has $1 billion in debt outstanding, so you subtract the billion, come up with a value of equity of $1 billion. There's 100 million shares, value per share is $10, right? So far, fairly straightforward valuation. You buy the shares at $10 per share. You paid a fair price. Now the company announces, the second after you buy the shares, that they've decided to give 10 million options. Remember there are 100 million shares outstanding. 10 million options to the CEO. But they say, don't worry about it, because these options are at the money. Basically, the strike price is set equal to the stock price. So here's my question for you. Think like a common stockholder. You bought the share just a minute ago for $10 per share. Think of the effect of this action on your value per share. Here's the first argument. You should have no effect on your value. Why? Because the options are at the money. Anybody here agree with that? You know how absurd that sounds, right? Just because an option is at the money, you can't say it's worth nothing. You know, for much of the last 20 years, this is how we've dealt with options. Accountants have told us at the time of the option grant that options are worthless because they're at the money. Using this argument, technology companies have given away big chunks of your equity and my equity to the top managers, saying there's no cost, it's at the money. The way it manifests itself, of course, is 2 years later, 3 years later, 5 years later, you hear of the CEO exercising his options and making $250 million. So clearly this answer should never have been even on the table. Okay? So let's cross it out. It cannot be none. The question is, how much will it decrease? Okay? Let me give you two answers, and you tell me which of these answers you're more likely to go with. It should decrease by roughly 10%. Why? Because there are 10% more shares. Okay? That's a pure dilution argument. The second argument is a little more nuanced. When people exercise these options, the CEO exercises his or her options. It's true that there will be 10 million more shares outstanding, but he has to pay $10, right? There's an exercise price here. So the second answer says your stock price will drop, but it will drop by less than 10% because even though the number of shares increases by 10%, there should be cash coming into the company. In fact, the first two approaches for dealing with equity options are going to take those two routes. Let's take the first one. The first one is what I call the bludgeon approach. The bludgeon approach, what you do is you just look at the number of shares. Remember that $1 billion equity value that I got? Instead of dividing it by the 100 million actual shares, I divide by the fully diluted shares. Anytime you see this fully diluted earnings per share, fully diluted, this is exactly what we're doing. We're counting the effect of the options and the number of shares. We're saying, let's assume they will all be exercised, and look at the value per share. Value per share I'd end up with is $9.09, which is the roughly 10% drop you saw. Right? What are the flaws with doing this? First, what is the probability that I'm attaching that these options will be exercised? 100%. What am I assuming the CEO will have to pay when the options get exercised? 0, right? Basically, I'm assuming that if these options get exercised, there is no cash coming into the company. When you use a fully diluted approach to estimating value per share, you're going to understate equity value because A, you're attaching 100% probability that the option will be exercised, and B, you're assuming that no exercise price, there is no cash coming into the company at the time of the exercise, which is not right. So the fully diluted approach, I think, is a very dangerous approach because it's going to understate the value of equity by missing both sides of the equation, both the fact that some options will not be exercised and the fact that when the options get exercised, there's a cash coming into the company. So give me a simple way in which I can factor in the cash coming into the company. How much cash comes into the company? Let's stay with the 100% probability of exercise. If all of the options get exercised, how much cash will come into the company? There are 10 million options. The strike price is $10 per share. So 10 million times 10 is 100 million. I could add the 100 million to the numerator and say that's the exercise proceeds I'm going to get. The value of my equity is $1 billion plus the 100 that I'm going to get in cash divided by the 110 million. And guess what? These guys will agree with the accountant saying no effect on your value. This is called the treasury stock approach for dealing with options. It's the most common approach in DCF valuations for dealing with options. Adding the exercise proceeds to the numerator, dividing by the number of shares outstanding. And there are subsets of these approaches. Some people use only in the money options. Some people use all the options. Some people use vested options. But both these approaches, in a sense, don't even try to wrestle with the fact that some options, there is a probability that they will not get exercised. And they don't wrestle with the fact that when these options get exercised, it's not just what you get in, but the stock price at the time of the exercise that you worry about, because that's how much I'm affecting my equity value. So the fully diluted approach and the treasury stock approach, both, I think, give you misleading numbers. One gives you too low a value, one gives you too high a value. This is like the Goldilocks and the three bears, right? There must be a better solution. So let's see what that better solution is. Let's step back. Is there some way that I can estimate the probability of an option being exercised and how much I'm going to pay out at the time of the option? What do you think option pricing models do? I know they get masqueraded behind ND1, ND2. You know what every option pricing model tries to do? When you estimate the value of an option, implicitly you're estimating a probability through that ND1, ND2 that your option will be exercised, and implicitly you're factoring in how much you will have to pay out. That's what the variance in the stock price does in there when the option gets exercised. An option value is, in fact, a probability-adjusted estimate of how much you will have to pay out on options. And already you can see the right way to deal with options. If you have options outstanding, treat them as options. Options are not 0-1 securities. Stocks are 0-1 securities. Options are not 0-1 securities. There's a probability that they'll be exercised, but no guarantee. So here's, I think, the right way to deal with options. And we'll actually take this example and work it through. Value the equity in the company in the aggregate. In fact, if you have options outstanding, never work with per share numbers. Do you see why it's going to be difficult to work with per share numbers if you have options outstanding? What are you going to use to come up with a per share number? Fully diluted, partially diluted? So if you have lots of options outstanding, take total net income rather than earnings per share. Take total cash flows rather than cash flows per share. Work with the aggregate numbers. You'll come up with an overall value of equity in the company, just as we did. Once you've come up with the value of the equity, here's the argument you should use. Some of that equity is going to go to common stockholders. Some of it is going to the option investors in the company. Value the options outstanding as options, which means if there's life left in the option, there's going to be a premium on the exercise value. Value the options as options. Subtract the value of the options from the value of the equity. That way you've taken care of the options outstanding. What's left is your money and my money as common stockholders. Divide by the actual number of shares outstanding, because already we've factored in the options. So the example that I've just used, all I have to do is value those 10 million options as options, subtract it from the $1 billion in value of equity, divide by the 100 million shares, I should be home free. This is where we've been stuck for the last 20 years, because when you get to this stage in the process, all those people who defend the status quo say, oh, that's too difficult to do. You cannot use option pricing models to value these options. And they have a little bit of a case there, right? What is different about employee options that makes it traditional Black-Scholes models were developed for listed options on the CBOE, for warrants, publicly traded options. Tell me what the differences are between the options listed on the CBOE and employee options in a company. There are actually at least three. Let's see whether you can come up with at least two of the three. What are the differences? Yes? One is that they're illiquid, which in a sense, holding everything else constant will mean that the option value you get from the option pricing model is probably going to overstate the value. Okay? So they're illiquid. What else? Yes? There is a vesting period. You know what how options work? You go to work for a technology company, they give you options. You can't exercise them right away. You've got to hang around 2 years. In fact, if you look at the tables, they'll give you vested options and total options. And there is a probability then that the options that are not vested will never get vested if the person leaves. So that's the second factor. What's the third one? If we enter into an option agreement in the CBOE, it's a side bet, right? There's a buyer and a seller. The company's not involved. There's no cash coming out of the company to meet an option exercise. Whereas options issued to employees come out of the company. That is why we worry about them as stockholders. There's a dilution effect that we have to worry about, right? Whether that dilution is explicit by issuing more shares or implicit by using cash flows that belong to us, they hurt our value as equity investors. So liquidity, vesting, and this dilution effect. And that's the argument that CFOs of technology firms have used for, hey, you can't really value employee options because it's too difficult to do. There is a way in which you can build in each one of those three factors into a Black-Scholes model or into a traditional option pricing model. Let's start with vesting. Vesting is the easiest of the three to deal with because, in a sense, all you have to estimate is a probability, right? If you can tell me there's an 80% chance of vesting, I can adjust the value of the options for vesting. So that should be the easiest one. What about illiquidity? What's the effect of illiquidity on if you own an option and it's completely liquid? Let's say you guessed right, the stock price goes up. What is in traditional option pricing theory, what happens if you're the option holder? Do you exercise the option or do you sell the option? If there's life left in the option. If it's a liquid option, we always assume you sell the option, which is one reason. If you look at the Black-Scholes option pricing model, we assume that every option gets held through expiration, because even if you don't hold it, it makes more sense for you to sell to somebody else rather than to exercise. Now, let's assume you're an employee in a technology company, Apple. Let's say you have 1 million options outstanding, looking at the stock prices at 85, and you're worried it might drop to 50. You have 7 years left on the option still, right? Do you see the incentive this might create for you to exercise early? Because if you're worried about the stock price dropping, as an employee option holder, you cannot assume you can sell it to somebody else. It's illiquid, so you're going to exercise earlier. In practice, you know what? Employee options will get exercised before expiration far more frequently than other options. In fact, it's been estimated, because we have this database now going back 25 years, it's been estimated that employee options get exercised about halfway through their stated life. So when you see a 10-year option out there, on the face of it, it actually gets exercised in 5. Is there a way I can build this into my Black-Scholes model? There's a simple way I can do it, right? When I value an option, what do I usually use? I use the stock price, the strike price, the stated life of the option. When you do employee options, given the empirical evidence, take the stated life, shave it by 50%. You're saying that's very crude. It seems to do pretty well in explaining option prices. So if the argument is that you cannot value options, I don't think that's true, because there are ways in which you can build the dilution factor. You can build in the vesting. You can build in the fact that options are liquid. In fact, the dilution factor, the easiest way to build it in is when you do a standard option pricing model, S is the current stock price, right? K is the strike price. So S is 10, K is 10, the option's at the money. But if you have employee options, the very act of exercising these options is going to lower the stock price, right? So rather than use the $10 stock price, which is today's stock price, you adjust the stock price for what would happen if all these options get exercised today, which will give you a stock price of $9.60 or $9.58. It's actually, I mean, it's a fairly simple process, because you bring in all the shares outstanding that would be outstanding if the option were exercised today, and come up with the stock price, which means you will lower the value of the option to reflect the dilution. So that's what I did. I took the 5 variables that would have been there in a standard option pricing model, S, K, R, T, and sigma. So basically I put them. In fact, I should probably have used a 5-year life just to reflect the illiquidity, but here I left it at 10. But I also factored in that $10 stock price today would probably be affected if these options get exercised. So the actual model, if you look at what I used a current stock price of $9.58 that reflects the dilution that's going to happen if all these options get exercised today. So other things remaining equal, the value that I'm going to get for this option will be far smaller than what I'd have got with a standard option pricing model. The net effect of this is the value that I get per option is $5.42. It's an at-the-money option, but it's costing me $5.42, and I'm paying for it as an equity investor in the company. How many options did I give away? 10 million options. which effectively means that this year my CEO got a compensation of 54.2 million. You might say that's not fair. He might never get to exercise it. True. But the expected value right now is 54.2. It's also possible it could be worth 200 million if the stock price moves in his favor. This is what we should have always done with employee options, which we never did until last year. Starting last year, if you're a company granting employee options, you have to do this. Finally, the battle has been won. Finally, reality has set in. Common sense has prevailed. And we agree that when companies give big option contracts to their CEOs, those option contracts have to be valued at the time of the grant based on the value of the option. It'll create all kinds of accounting issues now, because in later periods now you'll have to go back and adjust as the stock price goes up and down. But that's the cost you pay. As a company, you choose to go down this compensation route of granting options to your employees. Any questions? So basically, if you look at the value here, this is what I did. I valued the equity, 1 billion. Up till there, I did traditional DCF valuation. I subtracted out the 54.2 million, which is the total value of the 10 million options granted at $5.42. Came up with the value for the equity of 945.8 million. Divided by the shares outstanding. The value per share you will have as a stock, which used to be $10, has now dropped to $9.46. It's higher than the 909. I came up with a fully diluted approach. It's lower than the $10 that I get with the treasury stock approach. But to me, it's the most realistic way of assessing what happens to value of equity when you grant options. Any questions on employee options? Yes? I did. Okay. No, because remember that if you think about the total value of equity in the company, even with the $10 counted in, the value of the equity in the company, the cash proceeds doesn't fully cover what you're going to pay out, because they're not exercising right now. You're assuming, you're saying exercise value diluted value. Exactly. You have to factor it in, right? And you have to factor in that they're going to exercise only if the stock price goes above $10. They'd be crazy to exercise at $10. So that's why the dilution-adjusted stock price is always going to be lower than what you would get. In fact, the way you do it is you value the options and you put them in with the value of your equity. But you're saying, but to get the value of the option, I need... Notice that there are many of you in your DCF model, the option, if you look, there's a circular reasoning built into all the DCF spreadsheets which have an option worksheet in them. This is why I need it, because I need the value of the option to get the value of the equity, and the value of the equity to get the value of the option. Any other questions? Now, one final issue, and this is, I think, a question that I really don't have a clean answer to, because the tax laws are still evolving. That 54.8 million I said was the value of the compensation packet that you've given the CEO, so I should reduce it. However, if we think of this as compensation expenses are usually tax deductible, right? In which case, if you give away if they'd paid 54.8 million in cash, they'd have got a tax saving of 35 or 40% of that. And in effect, you get the same kind of tax saving with options, but you get it when you exercise the option, not when you grant the option. In other words, the tax laws and the accounting laws now are different. It used to be that the tax laws and the accounting laws both dealt with options only at exercise. Now the accounting laws deal with options at the time of grant, but the tax laws are still lagging behind. So for the moment, I have multiplied the option value by 1 minus the tax rate, but there might be a present value factor in there which I'm not considering, which is these tax savings might not show up till 2 or 3 years from now. Okay? So your effective tax savings might be lower than what I've computed, but I have no simple way of bringing that in. So I'm multiplying the entire option value, 54.8, by 1 minus the tax rate. So that's with existing options you've already granted in the past. So this takes care of options that were given out a year ago, 2 years ago, 3 years ago, 5 years ago, 10 years ago. But companies sometimes continue to give options, right? In fact, let's think about it. Why do companies use options to compensate employees? One is, of course, the alignment issue, but you could give stock and get the same alignment, right? Make managers think like stockholders. Let's face the bald facts. The reason companies use options to reward employees is because they don't have the cash to compete. I still remember in the late 90s when investment banks were big players here, and high-tech companies wanted to be big players as well, and they couldn't compete head-to-head against the investment banks with cash compensation. So you'd have .com companies show up on the list. Of course, none of them are around anymore. And the way they would compete for MBAs is they say, look, we can pay you only $80,000 in salary, but we will give you, $250,000 of options each year. So the reality is companies often give options because they don't have the cash to cover compensation, which means this is not a problem that's going to go away. So there are companies where not only do you have to worry about options already granted, but you have to worry about options that might be granted in the future, because that's going to drain your earnings and your cash flows in the future. If you think about options as compensation expenses, what do we do with the rest of compensation expenses when we project out earnings? Where does it show up? Where do they go into your projections? They go into your cost of goods sold, they go into your SG&A. Okay? So if you think about options as compensation expenses, here's the logical thing to do. You've got to project out how much you will grant as options as a percentage of revenues. Don't even try to figure out how many options and what. That's going to drive you crazy. So for instance, Cisco historically has given away about 2% of revenues as options to its employees. So when I sit down to value Cisco, I'm going to take the margins they have in the sector, but then I'm going to add an extra 2% to reflect the fact that Cisco grants options on top of those expenses. Their true margins are lower than they look because they're granting these options as compensation to their employees. I used to have to do that on my own until last year. Starting last year, this expense is now an explicit expense. So when you look at Cisco's income last year, you'll actually see this 2% show up as an actual expense, which actually takes a weight off my shoulder, because now when I compute margins and I compute expenses, those expenses are already embedded in there. But in those countries where this is still not the law, you will actually have to explicitly bring an option expense as an extra line item, which will reduce future earnings, future cash flows. That might seem like I'm double damaging the company, right? I'm reducing the cash flows, reducing the present value, then I'm subtracting the option value of existing options, but you're not. You're actually doing two separate things. One is to take care of options already granted, one is to take care of future option issues. Companies like Cisco, both will hurt your equity value. Companies like Amazon, it's only one thing to worry about, because Amazon no longer grants options to its employees. It gives restricted stock. Microsoft is the same thing. All you have to worry about is the legacy effect of old option issues. So it's only the first half you have to worry about. But look at your company. Your company might not be done granting options. Look at the income statement. If it's a U.S. company, you should now see an option expensing line item and how much it's affecting earnings. Well, yeah, unofficially, if you look at their income statement, they would show it as an expense, but the stated income, the stated earnings per share, the stated operating income actually hasn't done it. So you go back and look at them. They do in a footnote expense the options, and they show you what the earnings would have been if the options are expensed, but it's only for the pro forma earnings. Their actual earnings actually reflect. So when you look at the SEC earnings, those earnings from their filings are not after option expenses. So a lot of companies have claimed to do this for a while, but only the pro forma earnings, and you never see them actually unless you're asking for the pro forma earnings. Okay? Any questions on options? Think about why options are so deadly. The kinds of companies that grant options tend to be highly volatile companies, right? The options they grant are long-term options, and they might be at the money. But if you grant long-term options on a risky stock, you're giving away the store. What we're trying to bring in is the effect of that cost on equity investors today. Okay? In hindsight, we might have to go back and adjust, but in hindsight, we might have to adjust in both directions. Those companies that granted options in 96 and 99, we woke up to huge costs. Those companies that granted options in 2006, we're waking up and say, thank God those options are off our shoulders. Okay? So it can cut both ways, and your job at the time of the option grant is to make the best estimate you can on the value of these options. Any questions on options? Okay. Here's what I'm going to do now. We haven't done a single valuation. The last two sessions, this session and the next one, I'm going to spend doing some discounted cash flow valuations. Rather than bore you by taking you through company after company, every detail, what I'm going to actually do is, with each valuation, I'm going to focus on one or two key issues with that valuation. So I'm going to show you the big picture of the valuation, but in each valuation, I'm going to focus on a different issue. Here are some of the companies we're going to look at. We're going to start simple. Let's not get our ambitions too high. We're going to value a simple company, Con Ed. Okay? I'm going to talk about why it's a simple company to value, but then talk about a few issues with it, especially in relation to what I call implied growth, which is you estimate a growth rate, The market has its own estimate of growth rate. It would be nice to know what the market is assuming about growth in your company. So I'm going to back into an implied growth rate. Then I'm going to do 3 financial service companies, AB and AMRO, from 2003. So that's going to be a throwback valuation. Goldman from August of 2008, on the cusp of the crisis. And I'm going to make no apologies for the value you're going to see there. You're going to say, look at that value. I'm going to come up with $220 per share. As you know, Goldman's trading at, what, $90 per share, $85 per share. Then I'm going to value Wells Fargo just as the crisis was kicking in, from October of 2007. If I have a chance, I'm going to show an updated valuation of Wells Fargo from last week. So you can see this process kind of evolving as new information comes out about banks. Then I'm going to try to value the S&P 500 itself as a security. Hey, basically, I'm trying to answer the question, is the market overvalued or undervalued? If you think of the market as a collection of cash flows, we should be able to answer that question. So I'm going to try a dividend discount model, a free cash flow equity model, to look at how risk premiums play a huge role in the judgment we make there. Then I want to move to a fairly difficult company to value, a company called Qingdao Breweries, which is, at least at the time that I valued it, a small Chinese brewery with huge growth potential. And I want to kind of focus in on one thing that actually will make that company kind of troublesome as an investor, which is you're going to have negative free cash flows to equity for as far as the eye can see, not because the company is a bad company, but because the growth means that they have to put all those cash flows back. So I want to talk about what the effect is of having negative cash flows, how it affects your value. Okay? Then I'm going to move on to a couple of emerging market companies. Our cruise to talk about, with commodity companies, importance of normalizing earnings. Tube Investments, which is an Indian small family-run company, to talk about issues of corporate governance. What happens when you have a company that's actually earning less than its cost of capital and you don't see any light at the end of the tunnel? I mean, normally when a company earns less than the cost of capital, you say, oh, things will improve, I'm going to bounce back. But what if this company's done this for a long time and there is no way you can change the way the company is run? And then I'm going to close off with Embraer and talk a little bit more about emerging market risk and how exposure to developed markets can affect that valuation. Hyundai Heavy I'm going to use to kind of illustrate some of the issues we talked about with cross-holdings as part of that family of companies. How do you value those cross-holdings when some of them are private, some of them are public? Then I'm going to move on to what I call the dark side of valuation, which is when you have young companies, you have a temptation to kind of say the rules don't apply, therefore I can do whatever I want. Okay? So I'm going to take Amazon and talk about what happens when you abandon rules and what the right way to value young companies is. Then I'm going to take a couple of unusual companies, one with R&D, one with leases, to kind of show how those play out in valuation, because we've talked about how they affect cash flows and return on capital. I want to look at the end effect on valuation. And then I'm going to close off by looking at Global Crossing in 2001. At the time, it was almost on the verge of distress, but in general, to talk about how do you incorporate distress into a DCF valuation. In fact, this is a problem usually that's an exception rather than the rule. This semester, I've noticed that about 40% of you are dealing with distress, not because you wanted to, but because it was thrust upon you. You picked a company that you thought was a healthy company in October, and you're discovering that it's not that healthy right now. So I want to talk about how to bring in distress into your valuation. And I want to close off by valuing 3M twice, once separated by 5 weeks, once on September 12th and once on October 15th, again to illustrate how much the macro environment can affect your valuation. Okay? With each valuation, here's what I'm going to try to do. I'm going to first give you my rationale for why I'm using the model that I am. And then I'm going to talk about some of the tests I use as I use this model. So let's get the show on the road. Let's start with the Con Ed valuation. Before I do that, here's some macro data I want to give you because I want to keep revisiting this assumption over and over again. Since the valuations you're going to see spread the spectrum, some are from the late 90s, some are from 2005, 2007, 2008, 2009. Here's what I'm going to do. The valuations prior to 98, and I think there's only one. The risk premium you're going to see, the equity risk premium you're going to see is 5.5%. That was a historical risk premium then when I did the valuation. Between 98 and 2008, I switched to an implied premium, which for much of that decade was close to 4%, until September of 2008. The valuations you're going to see post-2008, I've come to the recognition that 4% is probably way too optimistic as a risk premium for the immediate future. So I'm going to use 5, 5.5, 6, even 6.5% risk premiums, depending on whether I'm doing the valuation in October. So you'll see me shifting my risk premiums as I go from October to November to December to January. But here's the constant you're going to see. I'm going to push the risk premiums up for the short term, but in the long term, I'm going to assume some kind of reversion back to a more normal number, 4%, 4.5%, 5%. Because I think leaving it at 7 or 7.5 or 8% is unrealistic. So you're going to see risk premium shifting depending on when the valuation is set. Okay? So here's the first valuation, Con Ed. Everybody knows what Con Ed does, regulated utility. So let me first explain. Yeah, go ahead, Malik.
So when you basically revert the
Risk premiums.
risk premium back, so are you using a historical then?
I'm using the average implied premium across time. Between 1960 and 2008, the average implied premium in the U.S. was roughly 4%. So I'm assuming that even though in 2009 I'm seeing 7%, that there's going to be enough of a mean reversion pull to get me back to 4%. Now this might be hopelessly optimistic thinking. We might be stuck with 7% premiums forever, in which case I'm going to overvalue companies. But that's a judgment each of you has to make. So I'm saying that just because you pick a 7% premium today, don't assume you're kind of locked in there. Revisit that assumption. You might decide to leave it at 7%, but do it deliberately. Don't let it kind of be automatic, because especially in this market, that's a big number that's driving your valuation. Yeah.
You also have to adjust it back.
Now, risk-free rate, if you're going to mess with the risk-free rate, mess with the growth rate as well. So to me, the risk-free rate in stable growth is irrelevant. Here's why. Let's suppose I leave it at 2.3%. I'm going to have too low a discount rate, right? What am I going to use as my growth rate, though? 2.3%. So if I want to use a higher risk-free rate, then I have to use a higher growth rate. So that's fine. So if you want to change the risk-free rate in stable growth, also change the growth rate in stable growth.
Well, I'm not only saying stable growth, but before that, when you change it from 6.4 to 5 and then to 4.
To what risk-free rate do you want me to change?
The risk-free rate should also, well, the risk premium dropping, the risk-free rate going up.
Well, I'm saying if you change the risk-free rate, then change the growth rate as well. Because if I change the growth rate, the effects kind of offset each other. What I cannot do is change one and leave the other as is, right? So if I change the risk-free rate from 2.2 to 4%, because I say, hey, that's what's going to happen, and I leave the growth rate at 2.21%, being that, then I'm going to have a problem. So if you change the risk-free rate in the future, and I have no problems in doing that, change the growth rate to make it consistent with your risk-free rate. Okay? So that's fine. So let's start with Con Ed. Let me first give you my rationale for the model. Why stable growth? This company's been around, what, 80 years? It's a regulated utility. Okay? So its growth has to come from two places. One is the population growing, actually three places. One is the population growing, second is power consumption growing, and third is prices growing. Two of those three are almost off the table. Population in this part of the country at least is pretty stagnant. It grows, what, 1%. We're not in Arizona or Nevada where you might have high growth kind of pushing up your consumption. Population is pretty stable. Power consumption is pretty stable as well. In fact, it's been dropping in the New York area, the region, for the last 5, 6, 7 years because you have more energy efficient appliances. So you're not going to get population growth. You're not going to get power consumption growth. You're saying, let's hike prices. What's the problem with that? They're a regulated utility, right? You know how they set prices. They have to go in front of a regulatory commission that's appointed by the state and plead for higher prices. So if they say we'd like to increase prices by 10%, the regulatory commission is going to shoot them down right there and say, maybe 2%, maybe 3%. So built into the company almost is the fact that it's going to be a stable growth company. Yeah.
What about
efficiency in what?
Well,
The plants are old, right?
yeah.
So you can, there's only so much cost cutting you can do when you've been around 60 years and your plants are old. So if you're thinking about moving to more efficient plants, that's fine. But then it'll be a one-time big investment you've got to make that leap into a new business. If you want to make that transition, but here's the problem. If you make it yourself more efficient, here's why there's no incentive to make yourself more efficient. It's cost plus pricing. You know how the regulatory commission works, right? If your costs are $8 billion, they will allow you to make a fair rate of return on the $8 billion. If it's $9 billion, they'll make it. So because it's cost plus pricing, what's the incentive for you to cut costs? If you cut costs, you know what the regulatory commission is going to do next year? They're saying you're making too much money. See, too much money. What does the regulatory commission actually look at to make that judgment on price increase? Does anybody know? They look at your return on equity versus your cost of equity. And if your return on equity is higher than your cost of equity, they will actually set lower price increases to push your return. It's almost by definition they're trying to push your excess returns towards zero. So You got to be careful that whatever you do, ultimately it's going to show up as a pretty low return on equity. You might be able to get that 1 or 2% fudge factor in there, but not much more than that. I'm sorry?
And it won't be long.
It won't be long term. So in a sense, if you look at them, this is the quintessential stable growth company because of the nature of the business and the nature of the regulatory oversight. Is this true for all utilities? Let's say you're valuing a British water company. One of the things British utilities actually got privatized 10 years ago in the classic sense of the word. The price caps were removed. They were thrown into a competitive marketplace. So don't assume that this is going to apply for every utility. But if it's a conventional regulated utility with a monopoly position, often that's going to come with pricing constraints. So that's why I used a stable growth model. Why equity? What drives that choice? Leverage and what I expect it to be, right? This is a company that's been at pretty much the same debt ratio for 30 years. It makes their life easier when they go in front of the regulatory commission if they have a fixed debt ratio. So I said, okay, equity. Why dividends? Here I cheated. I actually estimated the free cash flows to equity, and I estimated the dividends every year for the last decade. Over the last decade, this company has paid out 98% of its free cash flow to equity as dividends. It has a policy of paying out its free cash flow to equity as dividends because that's the way its investors want it to behave. They don't want it to accumulate cash. What is it going to do with cash in the first place? They don't even want stock buybacks. This is a classic dividend-paying company where the free cash flows to equity get paid out as dividends, which means I'm going to get the same value using free cash flow to equity models and dividend discount models. So why go looking for trouble? I decided to use the dividend discount model. So stable growth, dividend discount model, right? This is the easiest of all valuation models. I wish I'd picked this company. What are the three numbers I need? I need expected dividends next year, cost of equity and growth, and I'm done. Before I do that, though, I want to make sure that because everything rests on those three numbers now, if I mess up on one of those three numbers, my entire valuation is going to get screwed up. I don't have the luxury of saying I'll fix it in 5 years. So here are the overlay tests that I ran. First is, since the numerator is the dividends, the question I ask myself is, if I'm going to treat this as a stable growth dividend paying company, is it paying out dividends like a stable growth company? You say, what the heck does that mean? If I saw a 5% payout ratio here, you know what it's telling me? I might think about the growth being a stable growth, but it's not behaving like a stable growth company. Stable growth companies, especially if I'm going to use a dividend discount model, pay hefty dividends. Look at what Con Ed paid as dividends, 73%. So first red light turns green. That's okay. Dividends are going to be numbers that I can build my valuation on. Second, if I'm going to put in a stable growth rate, I can't forget the fundamentals, right? Growth rate is equal to return on equity times retention ratio. I have a return on equity for Con Ed, 7.7%. I said, look, the regulatory authorities are going to force your return on equity to cost of equity. Let's assume that's your return on equity. And I have a retention ratio of 73% is being paid out as dividends, 27% is being reinvested. So if I have a return on equity and a retention ratio, take the product of those two. Growth rate I get is 2.1%. That looks like a stable growth rate. You're saying what would trigger trouble here? If I saw a 35% return on equity. I don't think this company is ready to be put in stable growth, even if its growth rate is stable. There I might have a high growth phase just to get the return on equity to a number that I can live with before putting it in stable growth. What I'm trying to say is, don't just focus on the growth rate when you look at stable growth models. Look at the rest of the company. In this case, I'm looking at the payout ratio. I'm looking at the return on equity. And the final number that I looked at was the beta. What do I hope to see there if I want to use a stable growth model? I want to see a beta pretty close to 1. If I saw a beta of 3.5 or 0.4, this company is not ready to be put in stable growth yet. Or if I want to put it in stable growth, I have to take that beta and replace it with a beta closer to 1. The beta that I saw for Con Ed was at the low end of the spectrum, but I expected that. It's a regulated, very few companies have this kind of predictable earning stream, revenue stream. So the beta of 0.8 I can live with. So the payout ratio is okay. The growth rate looks okay given its return equity and retention ratio. And the beta of 0.80 seems like a stable growth company. So I can use the numbers. So here's what I used to value the company. I took the dividends per share from last year, $2.32. You're saying, why didn't you normalize? Nice thing about dividends is the company normalizes for you, right? They don't jump around with the earnings. They kind of give you the dividends that they think they can pay. Okay? That's not true for every company, but for Con Ed, I assumed those dividends per share were a reasonable starting number. 2.1% growth rate that came from their own fundamentals. And the cost of equity I used was the 7.7%, the risk-free rate at the time that I did this valuation. This was August of 2008. It was 4.1%, beta of 0.80. And this was before the trouble. So notice my risk premium is at the old 4%. Cost of equity of 7.7%. Take 232, grow it out 1 year, expected dividends next year, divide by cost of equity minus the growth rate, gives me a value per share of $42.30. Stock was actually trading at 41. Okay. Pretty close, $40.76. So basically, the key message I want to deliver on this valuation is when you use the stable growth model, if that's the model you've decided to go to right away, check every other parameter to make sure it fits, the reinvestment rate, the return on capital, the risk measures, because it's not just the growth rate you're locking in forever, you're locking in everything else about the company at its existing levels forever. Now, when you look at a value which is different from the market price, and I'll wager for every one of you this is going to be true, right? In fact, I'll be very suspicious if you send me a valuation where your value is exactly equal to the market price. It might happen, but odds are that's not going to happen. So when you come up with a value that's different from the market price, your first reaction, I must have screwed up, right? It's just natural, because when you're first doing valuation, it's a logical place to go. But here's a different way of looking at that difference. You made estimates about growth, and it's true, you could be wrong. The market's making estimates about growth, but it could be wrong as well. But it'd be nice if you could back out from the market price what the market's estimate of expected growth is, and then compare your growth rate with that growth rate. Right? So that's what I tried for Con Ed. I came up with a value of $42 plus. The market's coming up with a value of $40.76. I'm pretty comfortable with the cost of equity. I don't think there's much debate about the cost of equity. I don't think the problem is with dividends. I think we kind of agree. The market and I kind of agree with the dividends, which leaves only one input where there could be disagreement. This is the growth rate. So I said, let me just hold the dividends and the cost of equity fixed and try different growth rates. 2%, 1.9%. Basically, what I was looking for is what growth rate would give me a value of $40.76. And that growth rate is essentially an implied growth rate. Implied growth rate here is about 2%. I'm estimating a 2.1% growth rate. You know what that tells me? I'm pretty close to fair value. This is not a value. I'm not going to run out there and buy 1,000 shares of Con Ed because we're well within the realm. It could be that the cost of equity, return on equity was 7.6 instead of 7.7%. It's all going to break even. It's a conservative valuation, but the market seems to be making a similar valuation. In fact, I didn't intend to do this on this valuation, but let's ask a question. If you looked at this valuation, this was what, 6 months ago, 7 months ago? Take a look at the three numbers I used, right? Expected dividends, cost of equity, growth rate. What do you think's happened to those three numbers? Let's start with the dividends. Con Ed's pretty much stuck with its dividends. You look at its dividends, it looks like it's going to pay $2.32 this year as well, or a little more than that. Right? So dividends look like they've held their own, right? What about cost of equity? Risk-free rate obviously is now 3% rather than 4%. Risk premium is now 6.5 or 7%. So that's going to push up their cost of equity a little bit. Instead of 7.7%, you're probably around 8.5 or 8.6%. Which leaves us with what to use as our growth rate. If you make the assumption that the regulatory commissions are going to say, hey, you know what, your cost of equity has gone up, therefore we're going to allow you to raise prices, they're going to be okay. But here's the problem. Next year when they go in front of the regulatory commission is going to hire an expert who's going to come in with a historical risk premium of 3.88% and say, you know what, guys, your cost of equity actually went down. It's not fair. But this is a fight you're going to have with risk premiums because there's always going to be an expert on the other side. Oh, here's the Ibbotson premium. Here's the historical risk premium. I think they're going to spend at least 2 or 3 years trying to fight to get their return on equity back up to kind of cover their risk premium. And that'll mean that for a period at least their growth rate is going to stay low at the old return on equity numbers because they're not going to be given the benefit of a higher risk premium, which effectively is going to hurt them. I mean, I just revalued Con Ed last week. I came up with like $36 or $37. The biggest problem was this lag in the return on equity process that I think is going to hurt them. Because if they can jump to that new cost of equity, then they'll be okay, but I don't think they're going to be able to do that. Any questions on the Con Ed valuation? Yes? Why do most companies cut dividends? Because their earnings are unpredictable, right? Con Ed's earnings are not going to go down very much. I mean, what portion of their earnings income statement is this? That's a good side. That's a bad side. It means that the economy does really well. Guess what? The dividends are going to pretty much. It's like a bond with a little bit of price appreciation. That's the way to think about Con Ed stock. It has all the excitement of a bond. And I'm being facetious, but it has none of the excitement of being a stock, and that actually can be a good thing at periods like this one. So in this case, if you look at what they've paid as dividends, they've actually announced their dividends for the next quarter. It's exactly what they're continuing with the point. The kinds of companies that are cutting dividends are the companies that should be cutting dividends. GE is cutting dividends because its operating earnings are dropping. Okay? So this is, I think, a fairly unique company in terms of what it does, and because it's a regulated monopoly and can pass costs through, I mean, it's less affected. It is going to be affected by the lag process between its cost of equity going up and return equity kind of staying frozen. The regulatory authorities are going to be sticky for the next couple of years, saying the economy is weak, we can't raise prices. But that's a lag process. It doesn't mean that they will not catch up. They will catch up, but it'll take them a little while to get there. Right? Any other questions? So in this case, let me ask a follow-up question. And this is, I think, a generic question about what those costs of equity in a DCF valuation really tell you about future prices. Okay? What I'm trying to do is, a lot of equity research reports are stated in terms of target prices. I'm saying if you've done a DCF valuation and your boss says, I don't want a value today, I want a target price a year from now. How do you take a DCF value and convert it into an expected target price? So let's use Con Ed to kind of illustrate this process. Let's say you look at your valuation, you're pretty comfortable. 42.30 is the value per share today, right? Let's assume you're also comfortable with the 7.7% cost of equity that you've computed for Con Ed. And let's also assume that your expected dividends next year you think is a pretty reasonable number. So you like your estimate of value, you think your cost of equity is going to hold up, and you think your dividends are going to be pretty much where you expected them to be. Is there a way you can use those three numbers to tell me what the target price? So you're an equity research analyst. I want a target price for Con Ed 1 year from now based on your DCF valuation. I don't want a PE ratio applied by earnings per share. I want you to use the DCF to come up with the target price. How would you do it? Sorry? Go ahead. 42.31 by cost of equity. So let's be specific, right? Why cost of equity? Because you're doing an equity valuation, cost of equity. Is that it though? So so I should take 42.30 times 1.077. Will that be the expected price a year from now? Wrong sign. Minus the dividend. Do you see why minus the dividend? 7.7% is your total expected return for next year. Some of it is going to come from dividends. Some of it is going to come from the stock price. So it's going to be 42.30. If you have a calculator, you can help me out on this. Multiplied by 1.077, that will give me the expected price a year from now with no dividends, minus $2.32 times 1.021. It's the dividend you're going to receive. I think the value that I came up with this morning was about 43 something. If you can confirm that for me, that'll help. But what I'm trying to say is that 7.7%, part of it is dividends, part of it is price appreciation. You're trying to figure out what the price appreciation component is, which gives me an expected target price a year from now. 43.50, let's say that's the number. Okay. Yeah?
But that won't give you the expected return.
No, that's not. That's going to be my next question. Because that will be expected return if the stock were exactly fairly priced. Today, the stock price is only 40.76. Can you now tell me what return you're going to make on the stock, assuming your valuation is right? You come up with this target price, right? 43.50. The stock is actually trading at 40.76. What's the expected return going to be on the stock? It's going to be 40.76 to 43.50, which gives me a return of about 6% in price appreciation, plus the dividend on top of it, which will give me a total return on the stock of about 11.5%. Is that a good return? given its risk and the fact that you need only 7.7%, that's why we like the stock. That's one way to think about a DCF valuation. If you don't like the traditional structure of the DCF valuation where you compare the value per share to the price today, if you prefer the target price return that some people preferred presented in, you can convert a DCF valuation into a predicted price, then compare today's price to that predicted price and come up with a return. So if an investor says, if I bought Con Ed today, what would I make as a total return? You should be able to answer that question, right, from a DCF valuation. So everybody clear on how you do this? So take the value per share that you got, use your cost of equity to come up with a predicted value a year from now, but subtract out the dividends from it to give you the predicted price, and then compare to the price today if you want to measure return. Yeah. Yeah, but when you say target price, you're actually getting a target DCF value for your company. You're saying this is the intrinsic value. Intrinsic value. So in your DCF valuation, if you wanted to add, in fact, if you want to impress people, here's something you can do. You have an intrinsic value per share today, right? You can actually give me an intrinsic value per share every year for the next 10 years. If you have a 10-year projection, doing what we just did, you can say this is how my intrinsic value will grow over time. But you dig under, you realize it's not that impressive. What you've done is taken your expected return and built it in. If somebody asks you, what is the chance the price will adjust to that value, then you can bring in, hey, this is a long-term valuation. I can't guarantee anything. I would say that you say that no matter what. Because if you say, I guarantee you the price is going to be the target price, it's only going to get you into trouble. But you're right, it is a long-term value, but that's really a question of will the price adjust to that value in 1 year, 2 years, 3 years, 4 years, or 5 years. Right? But it's still your estimate of value a year from now. Well, I don't even think you need any. I mean, it's a question of it depends on what period of history you look at. If you get lucky, it could happen in 1 month. So I don't think historical data will help you that much. I think just common sense says if you have a short time horizon, you're probably better off trusting momentum and relative valuation than going with a discounted cash flow valuation. Any questions? Let's take a second valuation. This is a valuation of AB and AMRO from December of 2003. Very different point in time, so take those numbers with a grain of salt. Okay? So I've decided to use a dividend discount model. Why? Because I'm a coward. I can't estimate cash flows. I've kind of given up. Remember we talked about how difficult it is to estimate cash flows for a bank, CapEx, depreciation. I don't know. I'm entering into a Faustian bargain here, right? Because I'm saying banks pay out what they can afford to in dividends. And those of you valuing banks, especially this time, at this time of crisis, that could be a dangerous assumption, in which case we'll have to talk about what to do next. But at this time, in 2003, I said, you know what, I trust banks to pay out what they can. Here's what the numbers look like. Okay? I used a two-stage model for AMRO because at least based on my estimates, I was projecting a growth rate of about 8% in earnings and cash flows, and that was too high to be a stable growth rate. Too high relative to what? The risk-free rate then was 4.35%. Clearly, this could not be a stable growth rate. Okay. So here's how I started. I started with the existing earnings per share, 1.85 euros, and came up with an existing dividends per share. That's actually last year's number, but that's my starting number. I assume for the next 5 years that they would continue to pay out 48.65% of their earnings as dividends, which gives me a retention ratio of 1 minus that number, 51.35%, and that they would continue to earn a return on equity of 16%, which is what they'd earned historically. So in a sense, I'm anchored at the point in time in history, and I'm using those two numbers. The product of those two numbers give me the growth rate, which in turn tells me I can't use it as a stable growth rate. So it's kind of, I mean, it's not sequential. You try the growth rate, you decide what growth model you're going to use. I gave them 5 years of growth at 8.22% a year. Even in 2003, you could see that this could not last, that this is a competitive business, that the returns on equity are going to come down. In fact, after year 5, I put them in stable growth. I gave them a growth rate of 4%. Okay? That's a rule you're going to see me follow religiously in every valuation. The growth rate is always going to be less than or equal to the risk-free rate. The risk-free rate here is 4.35%. I set the growth rate at 4%. I also changed the return equity. It was 16% for the first 5 years. I pushed it down to 8.35%. That seems suspiciously precise, right? saying second decimal point, you know what I did? I set it equal to the cost of equity in stable growth. So what I did first was actually compute the cost of equity in stable growth at 8.35%. And I said if there's intense competition, the excess returns are going to go away. In a DCF valuation, when in doubt, this is the safest assumption to make about stable growth. If you cannot think of a competitive advantage to hang your hat on, set your return capital equal to the cost of capital, return on equity equal to the cost of equity. So in this case, return on equity is equal to the cost of equity, which in turn allows me to compute how much I can afford to pay out as dividends every year forever. Because if I want a 4% growth rate with an 8.35% return on equity, remember growth is equal to retention ratio times return on equity. I reverse the process. I have the growth rate, I have the return equity. The payout ratio I can afford to have with that growth rate and that return equity is 52.1%. That's another thing that I'm going to do religiously with terminal values. Whatever I reinvest is going to be consistent with my own estimates of growth rate and what I've assumed about return on equity and return on capital forever. So here's what I have. For the next 5 years, I'm going to pay out 48.65% of their earnings as dividends and grow 8.22% a year. After year 5, they're going to grow 4% a year and pay out 52.1%. So in a dividend discount model, I need expected dividends for the next 5 years and a terminal price, right? To get the expected dividends for the next 5 years, I take the earnings per share today, 185, grow it at 8.22% a year. So that's the earnings per share. My payout ratio is 48.65%, so there's my dividend each year. End of year 5, I stop that process. Don't take the year 5 dividends and grow it out one extra year at 4%. In other words, if you're going to go to terminal value computation, you can't take the year before and say, I'll grow it out at 4% because everything changes in your terminal year. Right? In this case, for instance, the payout ratio is going to be different. So in year 6, here's what I do. I take the earnings, 286, 275 growing at 4%. I apply the new payout ratio on this, which means my dividends are going to jump in year 6, reflect the lower growth, divided by my new cost of equity minus the growth rate, gives me the price at the end of the 5th year. So dividends for the next 5 years, present value of dividends beyond the 5th year. I discount them all back at today's cost of equity. There are two costs of equity floating around, right? One is today's cost of equity of 8.15%. The other is the cost of equity beyond year 5. The cost of equity beyond year 5 gets used in only one place, to get the terminal value. And once I'm done with that, I forget about that cost of equity. I discount them all back to today at today's cost of equity. What I get as a present value is 27.62 euros. Stock was actually trading at 18.5 euros. So if you look at the key inputs to this valuation, the key input is in fact the return equity number. If I change the return equity number, there are going to be ripple effects that affect everything. Think about it. If I used a 12% return equity, there's going to be a big change in my growth rate, big effect on my value. I mean, every valuation has a driver of value, and with banks, that driver of value is always going to be the return on equity. So as I go to the other two valuations, the Wells Fargo and Goldman Sachs, keep your eyes on the return equity because that number is what's going to drive the values that you see for those two banks. Any questions on the AMRO valuation? Okay. So make sure that when you put the growth to stable growth, that in terminal value at least, that everything else is consistent. Yes? Okay. All I changed was the beta was 0.95 for the only thing I changed was I pushed it to 1. Again, the argument being, if you're a stable growth company, in this case I could probably have left, since it was close enough to 1, I could have left it at 0.95, probably wouldn't have affected my valuation by more than a few cents. But just to keep myself from falling into a trap of not adjusting it, I pushed the beta to 1, that's the only thing I changed. So you make the beta 1, your cost of equity is going to be the risk-free rate plus the risk premium, 8.35%. Right? But in other cases, if you're doing a high-risk bank where the beta is 2 right now, it obviously makes a big difference to move the beta towards 1. But that's something we almost always should do in stable growth. Question, Louis? That's a good question. In fact, when you look at that stock value being much higher than the stock price, the stock looks massively undervalued, right? ABN AMRO is a Dutch bank. You're saying there's no country risk in the Netherlands. But the flaw with that reasoning is what? AMRO is huge emerging market operations. Okay? So if there's a flaw in this valuation, it's probably this number being 0%. Now, if I wanted to fix that, what would I do? I'd first have to get that pie chart of AMRO's operations, look at where their operations are, so Latin America, Asia, at least at a very rough level, bring that country risk in through that number. And maybe it'll be a 2%, 1.5%, 3%. I don't know how much they get from emerging markets. But that's clearly something that I should have done that I did not do, that probably is going to push the value down to 23, 22 and a half, 22 euros per share. Right? But that's a good point. I did not do it. Yes? I didn't change the risk-free rate. I don't think I changed it. I might have changed. In fact, you're right, right? The risk, yeah, I must have. That was a typo. That should be 4.35. That was my mistake. Yeah, just change that to 4.35. Right. Let's take a second valuation. I'm going to do a valuation of Goldman and weep after I've done it, but no, let me do it first. Okay. So valuation of Goldman in August of 2008, again before the troubles. Okay. Why dividends? Again, just like a bank. Estimating free cash flow equity for an investment bank is close to impossible. Okay. Why three-stage model? Because at least at the time that I did this, Goldman looked really good. Right? The return equity was humongous. The growth rate was in double digits, so I need a transition phase to adjust for that. Okay. In fact, the return equity I used for the first 5 years was 13%, but they were growing tremendously by reinvesting, almost 92%. They were not behaving like a stable growth firm. They weren't even behaving like a two-stage growth firm. They looked like they had growth from now through returning, and I treated them as such. 91.65% times 13% gives me a growth rate of 12% every year for the next 5 years. But even Goldman's going to run into some brick walls along the way. So starting in year 5 of a transition phase. During the transition phase, I'm lowering the growth rate from 12% to 4%. Again, stable growth, set just below the risk-free rate then. Okay? In stable growth, I was a little more generous with Goldman than I was with Amro. Amro, I pushed the return equity down to the cost of equity. Goldman, here's the brand name effect kind of contaminating my valuation. I said even in stable growth, their return equity is going to be higher it's going to be lower than it is today, but it's going to be higher than the cost of equity. Okay? All these Excel spreadsheets are actually on my website. So as you look at these valuations, what I hope you're saying is, if I were valuing this company, I would have done things differently. The reason I'm hoping you say that is that's the way you should approach valuation. This is my value of Goldman. Your value of Goldman should not be the same. You can start with the same raw data. So go to the Excel spreadsheet. You don't like the 10% return equity in stable growth. You think it should be the cost of equity. Set it equal to the cost of equity. That's the best way of understanding the dynamics that drive valuation is play with the numbers. Okay? This is your only real chance to play with numbers. Because once you have real money, you're no longer playing with the numbers, right? So better to play with the numbers when you have nothing writing on it other than just a grade. Okay? Then when you have real money and your client's money, your investment bank's money, God only knows who else's money, writing or the government's money. Okay? Yes, Kevin. I'm sorry? The 1.2 beta, in fact, because I gave them the higher return, even with the beta of 1.2, if you look at their cost of equity, it's still lower than the 10%. So 1.2 beta with this risk-free rate would give me a cost of equity, I think, about 9%. So I didn't give them a huge spread, but I still allowed them to earn a little above their cost of equity. Okay? So with banks, I pushed the beta down to 1. With investment banks, I said they're probably going to be at the higher end of the spectrum because they take the riskier parts of the business. You know? So that's going to push up my cost of equity, but it's still below the return equity. So here's the rest of the story. With that growth rate and that return on equity, my retention ratio is going to be 40%, which means I'm going to be able to pay out 60% of my earnings as dividends beyond year 10. That's a big change from what they're doing right now. Right now, they're paying dividends of about 8.35% of their earnings, right now being August of 2008. I'm actually projecting that payout ratio to jump to 60% after year 10 because growth is going to come down and returns on equity are going to come down. Yeah, Lewis. In this case, I actually stayed with the 2008 numbers, but there is no reason why you couldn't. In this case, it probably made no difference because if you look at Goldman's history, they pay very little dividends. But if you have payout ratios that go up and down, then it probably makes sense to look at an average across time. Okay? For companies where the payout ratio has been roughly 6, 7, 8, 9, which is what Goldman's case, single-digit payout ratios for a very long time, I stayed with the most recent year. Okay? But that's a judgment call you can make. Both the return equity and the payout ratio, you can both look at the history as well as last year's numbers and make your judgment on what you want to use. For banks this year, my suggestion is look at history, right? Because if you look at 2008 numbers, I mean, I'm going to show you Wells Fargo. Wells Fargo's actual 2008 dividend payout ratio was 250%. They paid out $5 billion in dividends. No, it was 200%. $5 billion in dividends, and net income was $2.5 billion. So they're being crazy? Well, they might be, but how would you explain that? The $5 billion in dividends reflects, their historical dividend payout ratio. Their net income went from $8 billion in 2007 to $2.5 billion in 2008. You can almost see Wells Fargo's top managers getting down on their knees and saying, please, please, let it bounce back. But they're behaving like it will bounce back in their dividend policy. So that's a case where if I take in the payout ratio from 2008 and try to do anything with it, strange things are going to happen in my valuation. There I would definitely look at averages across time to see what I'd come up with.
Payout ratio is so small
Yeah.
in this case that your ROE will change dramatically every year.
Not necessarily, right? Because if I take what I retain and I reinvest it at the same return on equity, I mean, you're assuming that the numerator stays fixed. Within my assumptions, it shouldn't change at all. Because I'm assuming that whatever gets retained makes that. So that's the significance of this assumption. If you feel that assumption is unrealistic, then it will change. But make it explicit then. Say my return on equity on my new investments is going to be only 7%. But don't keep the existing net income fixed and just change the book equity. So in this case, my dividends reflect a shifting payout ratio. 8.35% for the next 5 years. And then each year after that, it starts moving up towards 60. No fancy stuff, just in linear steps. So my expected dividends, notice how it balloons out after year 5. That's both because earnings are growing and because the payout ratio is changing. So I start with $1.57 in dividends, end up at $25. Therein actually lies an answer to the question. If you have a bank that doesn't pay dividends, can you use a dividend discount model to value the bank? Sure, right? The payout ratio today is 0, which is, I mean, Goldman, I could set the payout ratio to 0 for the next 5 years. My answer is not going to change that much. What's going to happen then is you get a 100% retention ratio during your high growth phase, and then as your growth rate decreases, your payout ratio will kick in. So as long as you allow for that flexibility, you're going to be able to value any kind of bank using a dividend discount model. You just need to be a little nimble. Yeah. Yes, Luis.
The model really doesn't account for the liquidity risk running up of
Well, there are two things it doesn't account for. One is the fact that the risk premium that I was doing this was a very different point in time. So there is that liquidity risk. But you're talking about capital ratios, regulatory capital effects, which can kind of contaminate everything you do. You're right, it doesn't get shown there. In fact, if I want to show that, if I'm concerned about it, which I'm going to do on the next Wells Fargo valuation, I'll show you the easiest place to show it. Because if you let it be an after the fact, in other words, you do a valuation, then I'll worry about liquidity risk, then it's going to be on the one hand and the other hand. So we'll talk about how to explicitly build in, but you're right. In August of 2008, if you asked me, am I worried about Goldman's capital ratios, you know what my answer would have been? You must be kidding me. Because if I were worried about Goldman's capital ratios, and that was considered by far the strongest investment bank out there, I'd have said everybody else is going to go bankrupt. But then maybe that should have been the right answer then, because, But, so we'll talk about what's changed since then. Clearly lots of things have changed. Yeah.
Sorry, how did you arrive to 60% payout?
Well, if I have the growth rate and have the return equity, the payout ratio comes out of those, right? It's not the payout ratio that I estimated. I estimated growth rate, 4%. I estimated return equity of 10%. To grow at 4%, so in other words, the key assumption in the terminal value computation is not your payout ratio, is what you think the return equity will be in perpetuity.
It's just because I was just trying to
Right.
think about banks, and I'm not sure, I don't know.
Right.
But they normally don't have that high.
Oh, no, they actually have higher payout ratios. Stable banks have historically had payout ratios of 70, 75, 80. Goldman is actually the exception in terms of, when you think about financial service firms. Financial service firms actually are among the highest payout ratios out there, which is part of the problem, because their payout ratios are so high and they're so frozen in their dividend payments that they're afraid to step back and cut dividends when in fact most of them should be. So I discount the cash flows back at that cost of equity. And incidentally, the cost of equity is 10.4% for the next 5 years, reflecting the high risk of Goldman Sachs. And this is even in the good times. But that cost of equity will start drifting down in year 5, not to a really low number, because I left the beta at 1.2. So you have shifting payout ratio, shifting cost of equity. What do you get as a present value? It's $222. As I said, look, it looked undervalued by about 30%, but I'm glad I didn't put any real money behind this particular valuation. Right? I did think about it. It's not like I had some force that's saying I must be wrong. I just didn't have, and I never got around to it. Yeah. It's in the earnings, right? It's in the earnings already, right? The earnings they report is after all those compensation expenses. If that bonus structure got frozen in some way, it's fixed, then it's going to show up as much more volatile earnings, higher betas. The nice thing about the bonus structure is this year the bonuses are going to kind of melt away in front of you. So it's actually a better structure from a compensation standpoint than a structure where you have fixed costs you got to pay no matter what. Right? Last valuation, little later in this process. So I've gone from a 2003 to August 2008. I'm still kind of blind to what's coming, right? This is October 7th, 2008. 3 weeks into the crisis, I sat down to value Wells Fargo. And here I did it because, you know, all this talk about banks had dropped in value by about 50%. And there's all this idle talk about how banks were an incredible bargain at that point. And in particular, people were talking about Wells Fargo, saying, hey, Wells Fargo's strongest bank out there. Now's the time to jump in. The stock is down to $33 from $60. So I said, okay, let's take a DCF valuation of Wells Fargo. Let me focus on the numbers that I did, in fact, adjust to reflect the 3 weeks that had happened. Wells Fargo, between 2001 and 2007, had a return on equity of about 17.6%. They had an incredibly successful 7-year run. In fact, the base year that I had was 2007. They had earnings per share of $2.16, paid out 55% of those earnings as dividends, and reported a return equity of 17 points. So this is almost the best of all scenarios as an equity investor. You get a big dividend, and the rest of the money is being invested at 17.5%. But you could already see the writing on the wall by October of 2007. The writing on the wall basically said that banks have had too little capital to cover the risks they've taken. I mean, that's what we discovered in those 3 weeks, right? Even big banks were waking up to the fact that the capital ratios were kind of slipping away. And the follow-up to that is, if that writing on the wall is read by somebody with good sense, they're going to raise capital ratios looking forward. Even if it hasn't happened yet, it's going to come down the road. This is the worry about liquidity capital ratios. Basically, looking forward, even if you assume that Wells Fargo's income stream is not affected, what does it mean if I tell you that they need a 30? Let's suppose I tell you that capital ratios across the board are going to increase 30%. Return equity has to go down, right? The easiest way to compute it is you can keep the net income fixed and say, what if I had to put aside 30% more book equity to get the same net income? That's all I did is I took the 17.56 and I divided by 130. Do you see why 130? Right now they're making on $100 of book equity, they're making $17.56. If I freeze everything else in place and I increase capital ratios, the effect is going to be lower return on equity, 13.5%. And I'm probably being conservative there, assuming net income stays frozen, right? If I make that assumption, that's the only change I really made to reflect the capital effect, 13.5%. That lowers my growth rate to 6% going forward. I also built in a risk premium, which in hindsight looks hopelessly optimistic, but in October of 2007, the implied premium had crept up to 5. I said, I've got to catch up with that number. I made it 5%. So slightly higher risk premium, an assumption that there'll have to be more capital set aside to deliver the same net income. Net effect is when I valued Wells Fargo in October of 2008, it didn't really look undervalued. The $33, the stock price had dropped, but much of it reflected this reality that looking forward, returns on equity are going to be lower. It's going to affect growth rates, and cost of equity is going to be higher. As I said, I just valued Wells Fargo a couple of weeks ago. The 2008 numbers are now in. They also bought Wachovia during the year, which is this huge indigestion problem they're going to have for a while. Okay? So I'll send you that valuation, but I'll cut to the chase. Right now, I said I'm not even going to try to estimate earnings and dividends in 2009. It's going to kill me. It's going to kill me because who knows what the rest of 2009 will bring. The key number that I need to get nailed down to value Wells Fargo going forward is my return on equity for Wells Fargo as a long-term return. Is it going to be 10%, 12%, or 18%? If I'm an incredibly optimistic person, I think everything's going to revert back to 2001 to 2007 numbers, then an 18% return on equity is the right return on equity. Wells Fargo is undervalued by about 50%. If I assume a worst-case scenario, which is returns on equity are going to drop to single digits, 9% plus, and costs of equity are going to stay high, Wells Fargo is overvalued by about 20%. So best-case scenario, undervalued by 50%, worst-case scenario, overvalued by 20%. I actually put my hopes on the middle scenario, 12% return on equity in the long term, which I think is doable for them, even with the higher capital ratios. And let's face it, they'll have less competition, right? That's the other thing we have to factor in. I mean, while we're all caught up with everything happening around there, we still have to do banking. 5 years down the road, there'll be fewer banks out there, which means that there'll be at least some degree of excess returns coming from that. So 12% excess return and a reversal back the equity risk premium down to 5.5 or 5%, then Wells Fargo goes back to being undervalued by about 20 or 25%. So really what I'm trying to say is, I don't know which of those three scenarios is the right one, but make that your bet. If you want to bet on banks, the bet you're making is about normalized return on equity in the long term and what will happen to risk premiums in the long term. That joint bet. So don't get distracted by all those middle numbers about capital ratios, dividend discount models, etc. Okay?